Hello and welcome to ETF Pulse, ETF.com's vodcast. I'm Kristin Myers, editor-in-chief of ETF.com and your host of ETF Pulse. Here, as always, with my co-host, Nate Geraci, president of the ETF store. Nate, as always, so excited to have you here and to chat. So let's take a quick look at the Pulse rundown. So first up, can't get away from crypto. Thanks to Nate here. So we'll be chatting Kraken. Crypto exchange is looking beyond crypto to start stock and ETF trading. And flows, we'll be taking a look at the massive amounts of cash that VOO or VOO has taken in, as well as China ETFs, which has seen a large amount of outflows amid the trade war. And collateralized loan obligation, also known as CLOs, that's a bit of a tongue twister. I almost got messed up there. There has been a sell-off in that market, and cracks are really starting to appear in the CLO issuers, among CLO issuers. So we'll be chatting about that and how it might impact you if you own any of those CLO ETFs. And then last up, we will be talking about PRIV or PRIV, PRIV. That is a SPDR private credit ETF. Hasn't been too much interest there, not too much of an uptake. So we'll be chatting about the flows there and why perhaps investors are not piling into PRIV or PRIV, however you decide to call it. So let's first talk about Kraken. Again, crypto exchange, Nate. Now it's moving beyond crypto. It's going to be offering stock, ETF trading. It is, just as a quick piece of context for all of the listeners, it is only being working right now in select states. So New York, New Jersey, I believe Connecticut might be one as well, but they're keeping it small in terms of this rollout before they're going to roll it out on a much larger scale at some point in the future. I have thoughts on what this might mean. I am curious to get yours because you are obviously such the crypto buff that keeps somehow making us talk about crypto every single week.
We have kept the streak alive with the crypto discussion, which I love. Yeah, so as you mentioned, Kraken rolled out commission-free trading on, I think they said 11,000
Yes.
U.S. listed stocks and ETFs. And to your point, only available in certain states now, but it sounds like there will be a nationwide rollout, right? This will ultimately be available everywhere. I'm not entirely sure how the end client experience will look, but in the press release, Kraken said that this will allow investors to seamlessly manage everything in one place on their mobile app. And so I'm assuming that means an investor logs in, they can see everything in one place. And obviously you can own ETFs in this case, stocks and crypto in the same place. Here's the thing, my take on this, I've said for a long time, I think crypto trading will be table stakes at every major brokerage. When I say every major brokerage, I'm talking all of the big players, Fidelity, Schwab, everyone, where you'll be able to hold, say, VOO, right next to Bitcoin. And you have one account login, you receive one account statement, everything is integrated. Mm-hmm. And we've had a little bit of a running theme or joke on this show just regarding the 24/7 trading, right? And I tie that in here because I think whether we like it or not, investors are now expecting 24/7 trading, but they want everything in one place. They want things like real-time settlement, which is what they've experienced with crypto. And so I think a move like this from Kraken is just another step down this path. And I actually want to read to you a quote from Kraken's co-CEO. So they said, expanding into equities is a natural step for us and paves the way for the tokenization of assets. The future of trading is borderless, always on, and built on crypto rails. And what they're saying here is that, yeah, the future is tokenization. And this is a very small step down this path, just where you have everything in one place. So I'm not making a huge leap from just that to tokenization, but it's this further integration of crypto in the equity markets, right? Crypto in the traditional financial market. So I think that's really the headline here. And I'll add to that, I don't think we talked about it a couple of weeks ago, but Fidelity recently rolled out crypto IRAs where you can buy Bitcoin, Ether, Litecoin in either a traditional IRA or a Roth IRA. And in this case, I think Fidelity requires you to have a brokerage account as well. So you have to have a Fidelity brokerage account, but then you can fund these crypto IRAs. But point being, Kristin, this is where it's all heading. There's not going to be a distinction, in my opinion, between, say, stocks and crypto.
Do you think, and this is kind of was my thought, obviously Kraken, we cannot compare it to the main brokerages, right? Kraken is not near the size of a Fidelity or a Schwab at all. But do you think that this is going to put even more pressure on sort of these mainstream brokerages that have expressed a lot of trepidation and hesitancy to move into the crypto space? Because if you can with Kraken, and I'm sure other crypto exchanges or brokerages are really going to start doing the same thing, right? Do you think that's going to put pressure on these sort of mainstream brokerages to actually start making some of these offerings? Because we already know that investors want it. They want to be able to purchase either crypto or crypto ETFs inside of their portfolios easily, right? No one wants to have 5 different investment accounts, 5 different passwords, all of these things that they have to remember. Do you think that that kind of puts pressure on them? Or do you think that this opens up the possibility for Kraken and others that really kind of start to make this move to start snatching up, particularly some of those younger retail investors, or even perhaps advisors working on behalf of clients that very clearly express that they do want to have crypto inside of their portfolios?
I think the answer is both. And I think without question, this is putting a tremendous amount of pressure on the big players that I mentioned before. And Schwab, they've said that as the regulatory environment evolves, they're going to offer spot crypto trading. So they're already following this. Fidelity, I just mentioned the crypto IRAs. I mean, they've been playing in digital assets for a while. But I think if you're a smaller brokerage, like say Kraken, you have the ability to be a little bit more nimble and move quickly and theoretically get in front of that audience before Schwab or Fidelity does. And so there's no question it's a competitive play. But this all goes back to what I was saying earlier. Maybe I didn't state it eloquently. I think particularly for younger investors, this is, again, it's table stakes. This is the expectation.
Yeah.
You said it perfectly. I'm not going to go log into 3 different accounts or 4 different accounts. I want to buy my ETFs. I want to buy my stocks. I want to buy my crypto all from the same place. I want to have a mobile app where I can see it all in one place. This seems obvious to me. And I think the reason why we're just now getting to this point, even with some of these smaller brokerages, is because of the regulatory environment.
Yeah.
And we know that the winds have shifted there. And so I fully expect, again, Schwab and everybody else to come in. Here's something else that I do think is interesting about this story, just to tie into the ETF space. And I've talked about this before. The ETF angle here is that if you can get crypto exposure directly in the same place that you buy your ETF, then the question becomes, do we really need crypto ETFs, right?
Yeah.
Like, why pay an expense ratio to iShares or Bitwise or whoever when you can just buy Bitcoin directly? Now, there is some nuance here, just when you talk about trading costs, if you're buying it on your own versus say Bitwise buying it and those sorts of things. But at a basic level, investors will have a decision to make. Do I want to go buy Bitcoin wrapped in an ETF, or do I just want to buy Bitcoin direct? And so I think that could actually be a negative for spot crypto ETFs moving forward, with one caveat, which is that, and I've always thought that this is where it was heading long term as it pertains to ETFs. I think index-based and actively managed crypto ETFs they'll have a place. Because if you want diversified exposure, I think people would be willing to pay a fee to get that diversified crypto exposure. However, maybe brokerages offer, crypto SMAs where you don't even need the ETF wrapper, right? So we'll see, but I think, there is some ETF impact here longer term that we'll have to watch and see how it plays out.
Yeah. I also, in a weird way, I think there's also a bit of psychology that goes to in one's ability to buy a whole share of an ETF and only a fraction of a Bitcoin, for example. I mean, and we know fractional investing has existed for a while, and yet and still, despite this, and we say this every time that there is for example, a stock split. Everyone's like, wow, okay, this is insane. The massive amounts of pickup that we're seeing on these stock splits, you've been able to fractionally purchase a share, right? But every time people like owning a whole of something instead of a small, tiny percentage piece of something, and especially with Bitcoin prices, I mean, up over $80,000. I believe they were at 86 last time I looked, but that might have been 1 or 2 days ago. They might rather spend $28 on a share, buy 10 of those shares for $280 and feel good about that instead of saying, oh, I'm only going to be able to purchase 0.0000123% of Bitcoin. But I do think that's a very interesting point, though, about, if you can buy it all in one place.
Why do we need the ETF?
And you don't need the ETF anymore, which obviously existed not entirely to make ease of access to the crypto market. But I mean, it is a large part, I think, that we did.
Yeah, it's a huge part of it. But I've always called ETFs these are a bridge between traditional finance and crypto or decentralized finance. And so they're serving their purpose right now. But I do think longer term, it will be normal to just own crypto directly in your account, again, alongside your Vanguard and iShares ETFs.
It's actually funny you just said that, because that reminds me of close and the CLO conversation we're going to have later, and even actually with Prive as well. But we're going to wait. We're going to talk about flows first. Okay.
By the way, can I say something real quick? I love how you pronounce different acronyms. Like we've talked about Priv and Prive and VOO and VOO. I say CLOs, but I was talking to somebody earlier who says CLO, just like you do.
CLO.
I know. I love that.
Because I usually am the one that says like VOO and you say VOO. You're the one that usually pronounces out the whole word.
We're always opposite on those. That's why I had to point that out.
For some weird reason, which to me makes the most, a CLO. It's a clear, very easily pronounced word. But we'll talk about those later. Prive, the debate rages on. Let's talk about flows though. We have two kind of flow stories, but let's focus on the main one, which is VOO. $50 billion of inflows so far year to date. I just took a look at the most recent numbers. I pulled it up on ETF.com, and it looks like the exact total is 49.8 billion. So I think we could just round it up. $50 billion of inflows so far this year. That is an absolute mind-blowing amount of cash, honestly. And frankly, looking at the chart, there was only a couple of days of outflows, and that was at the end of March when the whole kind of tariffs and everything really started to like hit the market. So I think the biggest amount of outflows that we had happened on March 25th, $17.7 billion worth of outflows. So despite these days of outflows, 50 billion of inflows, most amount of inflows so far happened March 14th, $14 billion of inflows. Some funds don't even touch that in an entire year.
Well, and the thing is, you would think with the recent market turmoil, maybe inflows would slow down. They've accelerated. Like I show, if you look last week, and it depends on when you pick your date, something like 11 billion went into VOO just over the week. And you'll recall, VOO shattered the annual inflow record last year with something like 115, 120 billion in inflows. And so to be, what would you say, 50 billion now? To be doing that with the S&P 500, I think as we sit here today, it's down, say, 7 or 8% year to date. That's impressive, because it's one thing for an ETF to take in a bunch of money when things are going good. We always say how flows follow performance.
Yeah.
But that's not what's happening this year. The last couple of years, it made sense because the S&P 500 had a tremendous run.
Went strength to strength. But yeah, you're right. Over the past 5 days, so just essentially almost last week's entire trading week, we were in the red. We dropped lower and lower and lower every single session. And to your point, you mentioned the number, but over 11 billion of inflows just over the last 5 days alone for VOO. So do you think that this is, I actually think this is a really good thing. I actually think that if we're seeing flows not necessarily follow performance, says to me something about the fact that people are thinking perhaps more strategically about the fact that this is going to be a long-term buy and hold play, right? And if you, therefore, because if you don't know by now, VOO is the S&P 500 ETF from Vanguard. So you are investing in the 500 biggest companies in the United States, which is in a weird way, or not a weird way, but which is in its own way, a bit of a proxy for the US economy. So if you believe in the strength of the US economy and where the US economy is going to go in the long term, then it makes sense for you to invest in VOO. And if you saw the markets essentially on a fire sale last week, then it therefore follows that this is also a really good time for you to sort of pick up some more shares of it. Yeah,
and those investors were largely rewarded last week. The S&P 500 did finish up about 6% despite all of the volatility.
Yeah.
One thing I would mention, and I think I've mentioned this before, is that anytime you have more volatile markets, there can be volatility in ETF flows because you have investors who they're tax loss harvesting and those sorts of things, right? So maybe they're selling out of SPY, the Spider S&P 500 ETF, and they're putting that money to work in VOO or whatever to maintain their exposure. But to what you were saying, I think we have a long enough track record here, or we have a long enough history here to know that the bulk of these flows into VOO are just investors continuing to put money to work, right? Nothing phases Vanguard investors. I always say, they're like the postal service slogan, right? How does it go? Like neither rain nor
Neither
sleet
rain
nor shine,
nor sleet nor hail shall keep like the postman
gloom of night or whatever.
rounds or something like. I was actually looking this up the other day. It's like one of my favorite slogans.
but that is Vanguard investors in particular. So they're not afraid of a little bit of market turmoil, and I think a lot of them actually see it as an opportunity. To your point, to buy the dip, keep putting money to work, and know that longer term things will work out. So on one hand, it's not surprising because we know that about Vanguard investors. We know that about VOO historically. On the other hand, it's not something that you see every day in the ETF space, as I mentioned before, because typically flows do follow performance.
Yeah. Well, I mean, you mentioned those numbers of like the total year inflows that VOO had in 2024. I mean, one quarter, essentially, we're just newly into the second quarter. I mean, we've taken in a third already of the inflows of last year.
I think that,
which we might, if we keep up this pace, we are going to have another record-breaking year for VOO. And not only a record-breaking year, it looks like it will handily beat last year's record in terms of those inflows. And if we can use this as a sort of proxy for what we might see for the entire ETF industry, then of course we're going to have massive inflows well over that 1.1 trillion we got in 2024. We should make a bet on this, what we think the inflows are going to be for the entire ETFs.
Last I checked, they were tracking for like 1.3 trillion. I need to go check the overall flow total. But I was just going to say with VOO, the 50 billion that's come in so far this year, that's right around what the previous annual record was. If I remember correctly, the prior annual record for an ETF, this is before VOO broke it last year, was in the low 50 billions. So think about that. I mean, this thing could absolutely obliterate the prior record. And I think you're right. I think that'll be indicative of ETF flows overall.
Yeah. Well, let's talk about the flip side, which is outflows. And let's talk about your favorite topic, Trump's trade war. Dun, dun, dun. I wish I had an organ that I could play. Because China ETFs had a huge amount of outflows, over $5.5 billion for the week ending last week, as investors are essentially getting the hell out of Dodge, and Dodge being China and China ETFs. This kind of made a lot of sense to me. There's a little bit of a thumbs up. This kind of made a lot of sense to me, obviously, with what's been happening with the trade war sort of like rankling markets. But we have seen European and international continuing to do incredibly well. So I thought that this actually might provide a slight opportunity for some of those investors that really wanted to pile into international. But yeah, essentially dumping out of those China ETFs. I want to know if we're going to see the emerging market, of course, which China plays a heavy role in when it comes to emerging market ETFs, if we're going to see that pick up back into those markets, especially as, and you and I have discussed this, you can't trade around the Trump trade war, Trump tariffs. People are anyway, clearly. If we're going to see a pickup happen as investors really start to move on and look at other things and they get over what's happening in the trade war and focus in.
You can trade around the Trump trade war, but you shouldn't.
Yeah.
Well, here's the interesting thing about the China ETFs. Well, it's a little bit of the opposite of what we were just talking about with the Vanguard ETF, because if you look, the China ETFs are actually up year to date. So like if you look at the CraneShare CSI China Internet ETF KWeb, last I checked, this was as of yesterday, it was up about 10% this year. If you look at FXI, which is the iShares China Large Cap ETF, that's up 7%. Now, to what you were saying, these are down big since mid-March, and clearly the tariff situation and the potential for an escalating trade war, we know those are the main culprits here. But, as an investor, if you see some of the rhetoric out there, think about, there's been this talk of Chinese stocks being delisted from US exchanges. That's not going to give you a real warm and fuzzy, right? We have talked about how you don't know what's going to happen from one day to another with this entire situation. But I think if you're just taking a step back and looking at the two, world superpowers butting heads over trade, that's a tough, do you want to trade into that? And so I think in the short term with China ETFs, you have some investors that are just taking their ball and going home.
Yeah.
They don't want anything to do with this. But to your point, or your question on emerging markets overall, again, international and emerging, that has outperformed the S&P 500. You're right. China's a big factor in that. I wonder, we saw this a couple of years ago. I wonder if some of the ex-China ETFs will get more looks on the emerging market side. That maybe investors say, I still want to have exposure internationally, but I'm going to exclude China from that.
Yeah.
And I want to have exposure to maybe some emerging market countries that are at least apparently getting along a little bit better with the Trump administration on trade. So that's where I'll be looking.
And we didn't actually talk about this or decide to talk about this today. We might in the future, but China decided to open up its capital markets. It's $500+ billion ETF market to essentially Western issuers, to the West, which is huge. And I think that comes as no surprise that this is happening amid the trade war. I would argue that if the trade war wasn't happening, that we probably wouldn't see Beijing making this sort of move. That's a little like international politics, geopolitical finance. But I think that depending on what they decide to do with that, we're going to have a conversation about that at some point in the future, because that could
You're saying they're just trying to have additional capital flow into local stocks there. I mean, that's simple.
Yeah, absolutely. All right. Let's talk about CLOs or CLOs. I think CLO is the right way to say it, personally. I get it. CLO, it's an acronym. Collateralized loan obligations. So some cracks forming in that market. Obviously, this is the problem when you invest in debt. When things do not go well in the market, or rather in the economy, debt is not necessarily somewhere where a lot of people want to be. And we have seen a ton of outflows. I'm just going to look at JAAA, or do you say J? You say J.
I love this. I say JAAA.
Of course you do.
I would expect you to say JAAA. That's exactly how I would expect you.
I said, you know what's funny? I said JAAA, I think, in the introduction. So I'm switching it up as I go along. So I pulled up JAAA over the past month, $2 billion in outflows. $1 billion of those outflows has come just in the past 5 days alone, as we are seeing investors obviously dumping out of the fund because of the market wobbles, the economy concerns, recession fears, all amid this sort of trade war. Now, here's the problem now. We are seeing JAAA and others having to sell off some of those bonds to essentially meet and pay out some of those redemptions and some of those withdrawals that investors are making. And this is why I think what I'm seeing happening in the sort of CLO market, the cracks that are sort of forming, less CLO issuances happening over the next couple of weeks and months. That is the exact reason why, and I think we'll talk about this as well in the next topic, why you truly have to understand what it is you are purchasing. Because if you just wanted to buy JAAA because someone said, oh, it's a great ETF or it's a great fund, you would have no concept of understanding what's really happening in the CLO market right now.
Yeah, there's definitely nuance there. You said, selling debt. Obviously, it's not all debt. There's some debt right now, such as short-term treasuries, that I think is very attractive to investors. Yeah. But with JAAA, which I don't know if you mentioned this, that's a Janus Henderson AAA CLO ETF. And you and I talked about that taking in massive inflows, right? It's actually up for an ETF.com award next week.
It is. I'm glad you mentioned it. I was going to say it's up for ETF of the year. And also best new ETF as well, I believe.
Yeah, and all that's, I think, well deserved. But
yes.
to I think what you were alluding to with all this tariff uncertainty, I think some investors are just wanting to dial back on anything resembling credit risk. Yes. Now, we should be clear with JAAA, this holds AAA rated CLOs, right?
It's in the ticker. Yeah. So for everyone who doesn't understand, they hold the highest rated debt, essentially. But obviously, any sort of CLO is going to be a leveraged play on credit risk and rates. So, yes.
Right. And that's where I was going to get. So these are higher quality, but I just think leveraged loans in particular are going to get sold off anytime there's real concern regarding the economy moving forward. And even if you look at like the credit spreads in that AAA CLO market, they've widened out, right? And if you think that's going to continue to happen, then you don't necessarily want to stand in front of that as an investor. And you can go, we're talking about CLOs here, bank loans. I kind of put those all in the same categories. If you look at ETFs like BKLN and SRLN, so those are the Invesco and SMIDR senior loan ETFs. And you look at the outflows from that category, it's a similar situation. And again, credit spreads, they've definitely widened recently. And so you get some selling pressure here, which, as you mentioned, that begets additional selling pressure. And I guess I'm not surprised here, because if you have concerns over the economy moving forward, you want to avoid, again, anything resembling credit risk, especially high yield junk. Anything that just looks junkier, you're not going to want to be.
Well, I mean, honestly, I just kind of pulled up the chart for the 1 year flows. I mean, flows have largely been pretty much one way into this fund, and it's been into the fund. I mean, over the past year, over $12 billion of flows. I believe the AUM has actually exceeded 20 billion. I'm pulling it up. I'm using the ETF.com fund screener right now to kind of pull up some of the information. And yep, right now the AUM sits at $19.7 billion. And obviously the outflows took a little bit of off of that AUM. So it did definitely exceed 20 billion. But yeah, if you look at it, it's just been raking in. JAAA has just been raking in cash over the last 5 years. It did launch towards the end of 2020. So it's not an Invest New ETF, but it is up for ETF of the year. We'll find out next week if they won or who won, since you don't know, Nate. And I know
who I voted for. I don't know who won.
I know who won, but I'll be honest, I forgot. So I can't even do a wink and a nod to anyone that's watching this right now. But no, this honestly might not be JAAA's year. I like JAAA better. I'm going to start saying JAAA. I think.
One other point, we'll see. But one other point that I would mention here is that while the CLO market itself is plenty big, it's plenty deep enough to support these ETFs. We're not talking about a market that is massive as some other categories.
It is not.
And so I bring that up now because you were mentioning those flows into JAAA. I do wonder. I'm not a big the ETF tail wags the dogs and these different asset classes, right? You get some of those headlines out there. But, again, this isn't a massive category. And so you had all these flows coming into JAAA. So you had that buying pressure on the market. I do wonder if you get an unwind of that, if maybe that does exacerbate the situation a little bit, because this isn't as big of category overall, if that makes sense. It's not quite as deep.
It's not. And it's also part of the reason why JAAA was able to pull in so much. I mean, it is literally the biggest of the CLO ETFs and has dominated in that space because it's the big fish in a small pond. If we're going to look at just the CLO ETF market right now, it is very small. All right, let's talk more debt. We've got PRIVE. I'm calling it PRIVE because it stands for the Spider Private Credit ETF. PRIVE. Do you call it PRIV or do you say PR?
I think the way you're pronouncing this is probably correct, but the way that it reads is PRIV, so my brain has a hard time with that. But I think they were going for PRIVE. So when I see that, that tells me maybe not the greatest ticker symbol.
No, a good ticker should trip naturally off the tongue. Right. And should also be easily remembered and also make you feel like you understand what the fund is about.
Yeah.
And when I hear PRIV or even PRIVE, I don't think debt. I think like cybersecurity or something like that.
Yeah, I would agree.
Yeah, but whatever. I guess SSGA hasn't asked us to join their ticker naming team. So although our services are available, and for a tidy sum, Nate and I can come help you name your funds. Okay, but let's talk about it because public and private credit ETF. Now, you and I talked about this when it first launched back in February. It launched at the end of February, so I believe that we talked about it in one of the beginning of March episodes. I can't remember the exact date, but we first asked the question, does the market need this fund? And the market has answered, because fund flows are a great way to gauge investor interest. And the response is no. $5 million of inflows. No, the market clearly is not interested. And also, I don't think that the timing helped them. I don't think that this is a good time to be, as we were just discussing with JAAA, I don't think this is necessarily a time that people are interested in getting into private or public debt or credit debt of any kind. Yeah, not especially when you see people paying for, Coachella tickets on Klarna. And but I think we do have to mention that, right? Like, this is not a great time to be, I think, in the credit space when people are thinking about the economy is wobbling.
What was it, like 60%?
60%. I had to mention that because I think that we do not. I think people hear those headlines and they go, "Oh, what's the big deal? Who cares if you can buy Chipotle on Klarna?" And I'm like, no, this is a huge problem then that is happening in terms of rising debt levels. If the American consumer has to pay off a $10 burrito, think that through. And therefore, and I love to connect the dots to everything. If you are therefore an investor in the debt market in the ETF space, whether it's an ETF wrapper or not, that should send some alarm bells to you.
Yeah,
but
you have hit on
inflows.
You've hit on, I think, everything that I would flag here. Now, I think we should acknowledge that it is still very early.
Yeah.
Right. So I think we need to state that, but
Only
it is looking
month and a half.
Yeah. So, but to your point, it's looking like private credit ETFs were way overhyped.
Yeah.
And I'm not that surprised here. You mentioned we talked about this back when this launched, and I said something along the lines like, I'm just not sure investors are clamoring to have private credit exposure. This seems like something to me that fund companies are pushing much more than what I'm hearing from actual investors. And I'm going to work in Bitcoin ETFs here only because prior to those, because I can, but prior to those launching, I kept hearing about the demand.
Yeah.
From real investors, real advisors. We want this, we want this, we want this. And that's why I was so bullish in my predictions for flows. It's been the exact opposite on the private credit. I'm not hearing anybody ask for this. And, to only have five.
Honestly, had to have been an interest in a market. It is not cheap to bring a fund to life and to bring it to market. It costs a lot of money, even for a huge issuer or a big mainstream issuer like SSGA, like State Street. So clearly someone had to have felt like there was a market for this.
I think the issuers, that's what I'm saying. And I'm not comparing private credit to ESG, but it feels similar where you had these issuers that were pushing ESG. Everybody should buy ESG. Nobody wanted it. And you're going to make my point here when you talk about who's involved, because think about, here we have an ETF with the third largest ETF issuer in State Street. We have Apollo, who's one of the biggest names in the private credit arena involved with this. There was a huge marketing push. They had media support, right? Every mainstream financial media outlet was running stories on this. And there's like $5 million that's gone into this. Now, there are some limitations with the ETF in that we don't need to get into the weeds. It holds between 10 and 35% private credit, right? It's not 100% private credit, obviously. And I think you make an excellent point, like we were talking with CLOs. The current market environment certainly is not helping here. I think poor timing, but a very underwhelming debut from Priv, to say the least.
Priv, it's definitely Priv. It's either. I would actually bet money it's either Priv or PRIV, is how it's being said.
By the way, sorry, I just thought of it. I saw a headline this morning that Vanguard is teaming up with Blackstone to try to figure out how to stuff private assets into, they didn't say ETFs, but it sounded like they're trying to make private assets more accessible to retail investors. And I just don't know why there's this huge push to push private assets into Ma and Pa's retirement account. I don't have anything. I'm not against it. I just don't know.
I don't either. Again, I don't even think if you and I were to go out on the street and just to ask, even Titan disagrees. We can hear him crying in the background, but even Titan agrees with us. So I just don't think if you and I were to go out onto the street, right, and just ask people, hey, do you even understand what like a CLO is? Do you even understand what it means to buy private debt? I don't think you would hear many people saying yes, right? And it's interesting.
Let's take that a step further, though. It's a great point. So then let's even say somebody goes, yeah, I know what it is. And then ask them to give you a nice investment thesis on it and be able to articulate why they should own that particular category, how they're valuing it, and how they're getting transparency into a very opaque market.
Wrapper on top of that. So,
you have, Wharton MBAs on Wall Street who can't figure this stuff out.
No.
Properly evaluate. So
that's because they don't have ChatGPT. They're not using ChatGPT, right? That's my new favorite thing. Ask ChatGPT.
I love ChatGPT.
Ask ChatGPT to explain something to you like a 10-year-old or a fifth grader and see what it comes up with. But no, really though. I mean, I think that the retail market has, and we've seen it massively explode over the last couple of years, and we've seen the retail market push into things like VOO, for example, and that makes sense. And in fact, I think anytime you talk to retail investors and you tell them, okay, you should be investing, here's how you should look at investing. I have not heard one person, and I certainly haven't when I'm talking to investors, that are people that are interested in getting investing or want to expand their investments beyond their 401k. I have never once mentioned funds like this. Ever as part of like a 5 to 10 either stocks or ETFs that they should really be focusing on. This is never a space that I have ever just said you should get into this.
Here's the other
not because
challenge.
There's no reason to get into this. I just don't think, to your point, there is a reason for, Joe and Sally on the street to be buying this up in large quantities. I think this is kind of comes to like, not every fund is for everybody, and not every investment strategy is for everyone. And we need to stop pretending that it is, like a buffered ETF can be a great tool. It's probably not great for a 22-year-old. I mean, that's fine. And that's fine. Right. Then that's fine. And so, yeah,
I was going to say, the other challenge that these products are going to have, and I've mentioned this before, is to think about financial advisors who, let's call them the gatekeeper, right? They're deciding what's going to go into a particular portfolio. Well, unfortunately, there are a number of financial advisors who like to sell exclusivity. And so what they like to do, Kristin, is go to their clients and go, hey, I can get you access to this, private credit fund, or I can get you access to this private equity fund. And so I don't know that those advisors are going to like ETFs like this out there, because it removes that cachet that they're selling to their clients, right? And so you're going to have advisors who do like to traffic in private assets. They already have relationships and they already have access to funds that they want to offer to their clients. And State Street disrupts that, which I think is a good thing. I like that.
I was going to say, that's actually, you bring up a very good point, because that actually is the whole point of ETF in general, right?
Which I love that aspect.
It is the democratization of investments, right? It gives people access. There was a point in time where if you wanted to purchase gold, you actually had to go buy gold, bars, bullion, ounces of gold. Now you could just go buy GLD or buy a different, gold or silver or whatever ETF. And so that's been the great thing about ETF. I think, to your point, there are times when people really enjoy and appreciate that sort of increased accessibility via the ETF wrapper and in the ETF market. But you are 100% right, because when it comes time to private equity, private assets, that is an area that has been sort of touted as the, you have to be in the know, in a sort of inner circle.
Red velvet rope. Right?
Yeah, exactly. To sort of get access to it. And the reason people have built it as this sort of exclusive thing is like, all the gains that you can make as a result, therefore cannot open up the floodgates to everyone. But again, open up the floodgates and there's been not a flood, it's been a mere trickle. We're going to have to see. I'm curious to know actually how, not only just to kind of tie this again back to the last topic, close, PRIV, whatever you want to call it, write us. Please tell us how you're actually pronouncing some of these tickers. I'm actually curious to know. I'm curious to know what we're going to see in the back half of the year, especially since once, hopefully, some of these economic sort of turbulences that we've seen kind of die down, because that, I think for sure, 100% has to be weighing on this particular space, and perhaps on this fund. Or if at the end of the year, the inflows into this fund are, a whimper and not a bang.
I'm going to go with there'll be a whimper. I'm not expecting massive flows.
I mean, I agree, but I can't bet against you on that one. I think you're 100% right. All right. Well, that is it for this week's episode of ETF Pulse. Be sure to check us out again next week. We'll be giving a nice little preview of the ETF.com awards, and we'll be doing a nice little special of Nate and I think maybe dressed up in it's not black tie, but Nate in a suit and me in a dress. We'll see if we can get a nice recording going at the awards itself and get everyone a nice special post-awards breakdown. But that's all for this week's Pulse episode.